Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Yeah, it is. It's really great to be here. We have quite the puzzle to solve today.
We really do. So I was looking at the data this morning, just trying to get a pulse on where tech is heading for you guys listening at home, and I saw a number in the research that actually made me do a double take.
Oh, yeah.
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 According to a recent analysis from market researcher IDC, they projected a 13% contraction in the global smartphone market.
Right. 13%.
13%. I mean, in the tech world where we're just so used to constant growth, that sounds catastrophic.
It does.
If a car company said sales were down double digits, we'd be talking about bailouts. It sounds like a massive recession signal, doesn't it?
It certainly grabs your attention. I mean,
Yeah.
when you see a double-digit drop in volume for the device that is literally glued to everyone's hand, the knee-jerk reaction is to panic.
Exactly.
It looks like the consumer is just completely tapped out.
Right. I'm picturing warehouses dusting over with unsold phones and, panic in the boardrooms out in Silicon Valley. But looking at the stock prices of some of these companies, they aren't crashing.
No, they aren't.
So what is going on? Is the data just wrong?
Well, the data isn't wrong, but the interpretation of, doom and gloom might be. That headline figure, that 13% drop in the number of phones shipped, is hiding a much more complex and, frankly, a more profitable story.
Okay.
So our mission for this deep dive today is to unpack exactly why the smartphone market is shrinking in volume, but evolving in value, and why your next phone might cost more, but do things you never even imagined.
So we're talking about selling fewer things, but making more money.
Precisely. But to really understand this, we need to set the scene a bit.
Sure.
It is Thursday, February 26, 2026. President Trump is back in the White House, and while the mainstream headlines are dominated by shifting economic and trade policies, the tech world has been battling its own very specific internal storm.
Right.
One that actually started way back in 2024.
Now, I remember seeing headlines about supply chains back then, but I kind of thought we fixed all that stuff after the pandemic.
They did, and then, we broke it again, just in a completely different way. Analysts are calling it the memory shock.
The memory shock. That sounds dramatic, like a medical diagnosis for a computer.
It really does.
What does that actually mean for the average person listening?
To understand the shock, you have to look at the ingredients of your phone. You have the screen, the battery, the camera. But the most price-volatile parts inside that device are the memory chips.
Okay.
Specifically, two types called DRAM and NAND.
Okay, hold on. Let's pause for the listeners, and honestly, for me too. DRAM and NAND. What is the actual difference? I know they're both memory, but why do we need two different kinds?
Sure. Think of it like an office desk.
A desk, okay.
DRAM is the top of the desk. It's your working space. It's where you put the documents you are working on right now. It needs to be super fast and easily accessible.
Right, so DRAM is my workspace.
Exactly. Now, NAND flash is the filing cabinet sitting next to the desk. It's a bit slower to open, but it holds all your photos, your downloaded apps, and your old text messages safely when you aren't actively using them.
Got it. Desk space versus filing cabinet. That makes perfect sense.
Good. Now, between late 2024 and mid-2025, the price of both the desk space and the filing cabinets just skyrocketed.
Wow.
And we aren't talking about a little bump due to inflation. We are talking about prices jumping double digits every single quarter. Looking at the data, HP even went on record noting that memory prices could jump 100% between quarters.
Wait, 100%. So the cost of those raw materials basically doubled in just a few months.
Yes, they doubled.
Why? Did a factory burn down or something?
No, it was actually a mix of strategic production cuts to artificially boost prices, combined with a sudden surge in demand from, we'll get to the AI part in a minute.
Okay, teasing the AI, I like it.
Right. But the immediate result was that for the phone makers, companies we call the set makers like Samsung or the big Chinese brands, their bill of materials just exploded.
Okay, let's use an everyday analogy here so we can all picture this. If I run a local burger joint and suddenly the wholesale price of beef and buns doubles overnight, I'm in serious trouble.
You are. And you basically have two choices. You can double the price of your burger to $20 and just pray people still buy it.
Which they probably won't.
Right. Or you keep the price at $10, but you lose money on every single burger you sell.
Or I suppose I could just stop making burgers until beef gets cheaper.
And that is essentially what the phone manufacturers did. That dynamic is the primary driver of that 13% contraction we talked about at the start.
Oh, wow.
It wasn't just that consumers suddenly stopped wanting phones. It was that Manufacturers couldn't afford to flood the market with cheap phones anymore. Their profit margins were getting squeezed to death. So they simply cut back on producing the low-margin, budget phones.
So the menu got smaller because the ingredients got too expensive.
That is a perfect way to put it.
But here is what I don't quite get. We're sitting here in February 2026. Based on the data, I've been reading that standard memory chip prices have actually stabilized now. The big panic is supposedly over.
That's true.
So shouldn't my burger joint be back to normal? Shouldn't we see a massive flood of cheap phones returning to the market right now?
You would think so, logically. If the costs go down, the volume should go back up. But this is where the plot really thickens. The market didn't go back to normal. It went premium.
Premium.
Yes. The era of the cheap, throwaway smartphone is rapidly fading. We are officially entering the era of AI replacement demand.
AI replacement demand. Now, I feel like every single tech company adds the word AI to their press releases these days just to boost their stock price. Is this an actual thing, or is it just marketing fluff?
Oh, it's definitely marketing, absolutely. But it is driven by a very hard, unavoidable hardware reality. Think about it up until recently when you used ChatGPT or Gemini on your phone. Where did that actual thinking happen?
In the cloud. My phone sends a query to some giant server farm out in the desert. The server thinks about it and then beams the answer back to me.
Right. Your phone was basically just a fancy walkie-talkie connecting you to a supercomputer.
Okay.
But the massive shift in 2026 is toward on-device AI. Manufacturers want your phone to do the heavy thinking locally, right there in your hand.
Why, though? Is the cloud not fast enough anymore?
Privacy is one huge reason. You really don't want your personal health data or your banking queries constantly leaving your device. Speed is another one. You don't want to wait for a distant server to respond if you have a bad signal.
That makes sense.
But to do that, to actually put a brain inside the phone, requires massive hardware upgrades.
Because you can't run a supercomputer on a cheap budget phone.
Exactly. You cannot run a complex, large language model on a potato. You need high-performance processors. And, crucially, a massive amount of that DRAM we talked about earlier.
The disk space.
Yes, the disk needs to be huge to hold all that intelligence at once.
So because the phone physically needs to be more powerful to run these new AI features, the manufacturers really can't go back to making cheap phones even if they wanted to.
Correct. And the market data completely backs this up. Cheap phones just aren't selling well. But expensive, high-tech phones, they're flying off the shelves. And this brings us to a really key metric you should know, ASP.
ASP, that stands for average selling price, right?
Right. This is the heartbeat of the new tech economy. Even if companies sell fewer phones overall, they are making more money per phone because everyone is being nudged, or honestly kind of forced, to buy the Pro or Ultra models just to get the features they want.
It's exactly like what the car market has become lately. I feel like you can't even buy a basic entry-level sedan with hand crank windows anymore.
That is a fantastic comparison. Imagine a local car dealership. 5 years ago, maybe they sold 100 cars a month, and mostly they were compact, affordable sedans.
Okay.
Now, they only sell 80 cars a month.
So their volume is down 20%.
Right. But those 80 cars, they are all luxury electric SUVs with self-driving features, heated seats, and giant touchscreens. The dealership is actually making significantly more profit, even though the lot looks a bit emptier.
Because they traded volume for value.
Exactly. In the industry, they call it a mix improvement. The mix of products being sold has shifted heavily to the high end.
Okay, so who is the best salesman at this new luxury dealership? Looking at the landscape, I have to assume Apple is leading the charge here.
Apple is the absolute master of this. According to the research data, Apple has been aggressively pushing this mix improvement strategy. They face those exact same high component costs with the expensive memory chips. But instead of just eating the loss, they used AI as the lever to push consumers up the price ladder.
How so? Like, what did they actually do?
They gated the best features. They effectively looked at the consumer and said, look, if you want this incredible new AI that summarizes your emails instantly and edits your photos like a professional, you simply cannot use the base model phone. The hardware won't support it.
Ah, so it's not just pay more for a nicer titanium color. It's pay more or your phone is dumb.
Exactly. They made high-capacity memory, moving from 8 gigabytes of RAM up to 12 or 16 gigabytes, a strict requirement for the modern user experience, and consumers are absolutely biting.
That is a brilliant if very expensive strategy for us buyers. But what about the guys making the brains of these devices? I'm thinking of companies like Qualcomm. Are they just selling chips, or are they doing something different in this new era?
Qualcomm is undergoing a really fascinating pivot right now. For years, Wall Street looked at Qualcomm and said, okay, they are a chip maker. They make the modem that connects my phone to the cell tower.
Right.
But now, Qualcomm is positioning itself as an edge AI platform company.
Edge AI platform. Okay, let's break that down for the listeners. Edge means what? Not the cloud.
Correct. The edge is the physical device in your hand. It's the edge of the network. Qualcomm isn't just selling a modem anymore. They are selling the entire neural processing unit, the actual brain, that allows these complex AI apps to function locally.
So to go back to our car analogy, they aren't just selling the tires or the engine anymore. They are selling the entire self-driving computer system.
And that is a dramatically more valuable place to be in the supply chain. If you are just a part supplier, you are a commodity. But if you are the platform that runs the AI ecosystem, you are indispensable.
So Apple wins, Qualcomm wins. Who loses in all this? Because someone has to be on the wrong side of a 13% volume drop.
The data points very clearly to the Chinese OEM manufacturers. These are the brands that typically rely on high volume and razor-thin margins. They traditionally flood the developing world with decent, very affordable phones.
The volume game.
Right. But remember the memory shock. When the price of their core ingredients doubled, those thin brands just evaporated. And they don't have the intense brand loyalty that Apple does.
Right, they can't just raise prices.
Exactly. They can't just tell their budget-conscious customers, hey, you need to pay 20% more this year. Their customers will just walk away. So they're getting aggressively squeezed from both sides. High costs on one end and lower consumer demand on the other.
That makes a lot of sense. It's a really tough spot to be in. Now, I want to bridge the gap with something else I saw in the reports that kind of confused me.
Yeah.
We've established that smartphone volume is down, and we know PC sales are pretty flat too. I mean, are you buying a new laptop this year?
Definitely not unless this one explodes on my desk.
Right, exactly. So if the two biggest products that actually use memory chips, phones and laptops, are stagnant in terms of total volume, why are the memory chip companies' stocks doing so incredibly well right now? Why aren't they going broke?
This is what I call the tale of two memories. And if you are an everyday investor tuning in to understand the market, you really need to listen closely to this part.
A tale of two memories. Okay, I'm listening.
The memory market has effectively split into two completely different worlds. World number one is general memory. This is the standard stuff sitting in your laptop or your older smartphone. Demand there is stabilizing, yes, but it's boring. It's flat.
Okay, and world number two.
World number two is HBM. That stands for high bandwidth memory. This is a special, incredibly fast type of memory where they literally stack memory chips on top of each other like a tiny skyscraper to exponentially increase the data speed.
A skyscraper of memory, and what exactly uses that?
AI servers. The massive supercomputers running ChatGPT, Claude, and Gemini. Those servers essentially drink HBM. They cannot function without it. So the demand for this specific type of high-end memory is absolutely explosive.
So we have boring memory for our everyday gadgets and super memory for the AI gods.
Let's go back to a car analogy. What works perfectly here? Think of general memory as regular unleaded gas. It's everywhere, it's relatively cheap, and the demand is very predictable. People fill up when they need to drive to work.
Okay, regular unleaded.
Now think of HBM as rocket fuel. It is extremely scarce, it is very hard to refine, and it is incredibly expensive to buy. But there's a massive space race going on right now.
Right.
Every big tech company, Microsoft, Google, Meta, has a multi-billion-dollar space program. They are desperate for that rocket fuel to power their AI server farms.
And they will pay whatever it costs to get it.
Exactly. So while the gas station selling to the PC market is quiet, the rocket launch pad selling to the AI server market is booming. This dynamic has single-handedly saved the memory makers. A slump in smartphone sales doesn't crash the memory market anymore because the massive AI infrastructure build-out is holding the entire industry up.
That is a huge structural shift. For 20 years, if phone sales sneezed, the chip market caught a cold. Now the chip market has an immunity shot.
An immunity shot made purely of AI.
This is all fascinating, but I want to make sure our listeners, the everyday investors who are trying to learn the ropes, can actually use this information. If I'm sitting at home looking at my retirement portfolio or reading an earnings report, what do I actually look for? Because clearly, a 13% drop in volume wasn't the right metric to panic over.
You are exactly right. You need to change your lens. You need to completely stop looking at the old metrics like shipment volume.
So if I see a headline that says Apple sold fewer iPhones this quarter, I shouldn't automatically panic.
Not necessarily. You need to look deeper into the numbers. Based on the data, here are the 3 specific things I would look for in any tech earnings report right now.
Okay, get your pens ready at home. Hit me. Number 1.
Number 1 is the AI mix. Look for data on how many premium or AI-enabled devices a company sold versus their basic entry-level ones. That shift in the mix is where the actual profit margin lives today.
Okay. AI mix. Number 2.
Number 2 is memory capacity trends. Are they moving their average phone from 8 gigabytes to 12 or 16 gigabytes? If you see that RAM number creeping up across their product line, that is a highly bullish signal for the memory makers like Micron or SK Hynix, and it shows the phone maker actually has pricing power.
Because more memory equals a higher price tag for the consumer?
Exactly. And the third metric is ASP growth, is the average selling price ticking up. If a company sells 10% fewer phones overall, but their average price went up 15%, they are actually growing their revenue.
So stop counting the boxes and start counting the value inside the box.
Precisely. And one more quick thing on valuation. Investors really need to stop viewing companies like Qualcomm as just hardware sellers. Wall Street gives a much, much higher valuation multiple to platform companies.
Right.
If Qualcomm proves they are the foundational platform for edge AI, their stock price multiplier could change significantly.
That is a really key distinction. Hardware is a replaceable commodity, but platforms are an ecosystem you get locked into. All right, we've painted a pretty rosy picture of the tech world here. AI is saving the day, premium phones are massively profitable, and memory makers are selling rocket fuel at a premium. But you are the expert, and I know you always like to look for the cracks in the dam.
Always.
What could go wrong here? What are the actual risks to this super cycle?
There is always a risk, especially when an entire global industry bets the farm on a premium-only strategy. The biggest risk right now is simply the consumer.
You mean us, just getting tired of spending money.
Exactly. Look at the macroeconomic picture. We have President Trump in office pushing new trade policies, global interest rates are still relatively high, and general consumer spending in the US and Europe is showing signs of slowing down. The big question, the multi-billion-dollar gamble these companies are taking is this. Will everyday people actually pay $1,200 for a phone just to get some AI features?
That is the real question. I mean, think about it. I upgraded my last phone for a better camera because I have kids and I want good photos.
Right.
I upgraded the one before that for 5G because I needed faster email for work. But do I genuinely need AI to summarize a recipe web page for me? Is that worth dropping $1,000?
And that is exactly the danger zone. If AI doesn't become a must-have feature for the general public, if it doesn't become as essential to daily life as the camera or the internet browser, then this whole replacement cycle could just stall out completely.
We might just look at our current phones, say, hey, my iPhone 15 is perfectly fine, and keep it for 5 or 6 years.
Exactly. If the consumer collectively decides that good enough is actually good enough, then the manufacturers are going to be left holding expensive parts, very expensive phones, and absolutely no buyers.
That is a precarious ledge to be standing on. The industry is essentially trying to force a massive behavior change, trying to make us dependent on AI.
They are betting their bottom line on a fundamental shift in how humans interact with computers.
Wow. So, as we wrap this deep dive up, what is the one big provocative thought you want our listeners to mull over today as they go about their week?
I want the listener to really consider this concept. We are actively moving from a quantity economy to a quality economy in the tech sector.
Okay.
For the last decade, the main question was simply, did you buy a new phone? It was all about mass consumption and unit volume. Now, the question you should be asking yourself is your phone smart enough to run your life?
Is your phone smart enough to run your life? That is a very high bar.
It is. The core value isn't in the plastic and glass hardware anymore. It's in the intelligence embedded inside it. We're watching the transition from hardware to intelligence-ware.
Intelligence-ware. I really like that term. Well, let's do a quick recap before we sign off, just to lock all this in for the listener.
Okay.
First, that scary headline about a 13% drop in phone sales, it is misleading. It's largely due to a supply crunch, that memory shock we discussed, that forced companies to stop making cheap, low-margin phones.
Right.
Second, the market has definitively shifted to high-end AI devices. If you aren't selling premium, you are struggling. This is that car dealership model selling fewer but much fancier cars.
This is correct.
And third, the memory chip market has completely split in two. Your everyday laptop memory is boring unleaded gas, but the AI server memory, the HBM, is rocket fuel, and that is where the explosive financial growth is happening.
That sums it up perfectly.
Well, there you have it. Your phone is getting smarter, your wallet might be getting a little lighter, but the investment landscape is honestly more fascinating than ever. Thank you for guiding us through that maze today.
My pleasure. It's always fun to dig into the details and look past the headlines.
And to our listeners, thank you for tuning in. Don't forget to subscribe and hit that like button. We'll catch you on the next deep dive.